Amid all the tariff hubbub on Wednesday, a separate story was quietly brewing for a copper and gold producer focused on Peru. Sierra Metals, whom operates two copper dominated mines, saw a renewed attempt at a hostile takeover that began back in December. Except this time, shareholders were offered a substantial 44% premium to the prior session's closing price on the equity. And quite frankly, the deal seems to be pretty enticing to a casual market observer who has no skin in the game. But Sierra seems to think otherwise. Let's dive in. The takeover attempt comes from Alpayana SAC, a private Peruvian miner that has incorporated a separate subsidiary in Canada in an effort to sidestep recent foreign acquisition rules introduced by the country. Originally launching its hostile takeover attempt back in December, the company has renewed its efforts, increasing its original cash tender offer of 85 cents per share by 31% to $1.11 per share. Whereas that original offer amounted to a 26% premium over the 30-day volume weighted average price as of December 13th, the day before the original tender was announced. This offer amounts to a 64% premium over that figure. Perhaps more importantly to current Sierra shareholders, the offer is also a 41% premium to Wednesday's close. And in this market post-tariff announcement, that premium sounds pretty darn good. And if the premium didn't already suggest it, Alpayana seems to want Sierra bad. Aside from increasing an offer nearly 4 months after the initial offer was made, the private miner has also said that if they are able to secure 50% of the outstanding shares, they will proceed with the takeover. Industry standards typically see that occur once 2/3 of the shares are secured. So what's in it for Alpayana? Well, let's take a glance at Sierra. So, who is Sierra Metals? Sierra bills itself as a mid-tier copper producer who benefits from precious and base metal byproducts. The company owns and operates the Yaracocha mine in Peru as well as the Bolivar mine in Mexico. Yaracocha is an underground mine that produces silver, lead, zinc, copper, and gold. The mine, which is estimated to have about 13 years of mine life remaining based on reserves and resources, has a mill throughput capacity of 3,600 tons per day. Copper equivalent production in 2023 equated to 41.1 million pounds at an all-in sustaining cost of $3.51 per pound. Well, for 2025, production is expected to be in a range of 48.2 to 52.3 million copper equivalent pounds at an AISC of between $291 to $311 per pound. We should also state here that the Yaracocha mine is held through Minera Corona, a subsidiary of Sierra's that is publicly traded in Latin America, which Sierra owns an 82% interest in while controlling 92%. The Bolivar mine in Mexico, meanwhile, is an underground operation focused on copper, silver, and gold, capable of processing 5,000 tons per day. The mine also boasts a 13-year mine life, while production last year equated to 40.2 million copper equivalent pounds at an all-in sustaining cost of $3.41 a pound. All told, the company posted top-line revenues of $273 million in 2024, with total net income of $16 million and adjusted EBITDA from continuing operations of $74 million. And while the company ended the year with $20 million in cash, there's a bit of a working capital problem. Sierra has $77 million in current assets compared to $104 million in liabilities, meaning working capital is negative. Going back to the tender offer, Alpayana has made a fairly reasonable argument for why shareholders of Sierra should agree to the offer. First, they say that their offer comes despite the recent restatement of Sierra's third quarter results, the balance sheet weakness, high production costs, and lack of strategic optionality. First, the comment on balance sheet weakness is rather accurate. The company has negative working capital, as we highlighted. And on top of that, the company has $96 million in debt, the majority of which bears interest at the 3-month SOFR plus 6.5%, which right now equates to a rate of just over 11%. The company also has an unpaid obligation to their publicly traded subsidiary of $56 million as per Alpayana, although this wasn't mentioned in the most recent financials due to the way intercompany eliminations work. Second, Sierra does have a rather high production cost at $3.41 a pound at Bolivar and $3.51 a pound at Yaracocha. Third, those restatements actually were somewhat material. They saw inventory decline by 7.8 million, while costs of goods sold increased 5.3 million. Adjusted EBITDA as a result fell from 51 to 45.9 million, while net income fell from 8.7 to 5 million for the 9 months ended September 30th. And lastly, on the point of a lack of strategic optionality, truthfully, it's a bit of an obscure complaint. Alpayana then goes on to state that if the offer is rejected, well, shareholders are likely subject to dilution, with Sierra likely needing to raise funds to pay its bills, with Alpayana claiming that $60 million is needed to settle just the working capital issue. It seems like a bit of a stretch, but Alpayana is doing its best to shake some shareholders loose here, and we'll give them credit for trying. All this commentary from Alpayana is great, but let's level the playing field a bit here before we get carried away. Despite these complaints, well, Sierra clearly has some value in it. After offering 85 cents a share in December, they've now come back groveling with more cash in hand in an attempt to win over shareholders with an offer of $1.11 per share. If Sierra were down nearly as bad as Alpayana claims, they would have walked away rather than coming back to the table. As Alpayana themselves say, it was an unsolicited offer. So keep that in mind. They've also said that if they acquire less than 90% of the Sierra shares, they'll pursue other means to acquire the remainder. And if they only get 50% of the shares, well, they're still going to go through with the purchase and will do what they can to secure ownership of the Peruvian asset. The shareholders of Alpayana are also shareholders of Minera Corona, Sierra's publicly traded subsidiary. So they clearly like the mine, despite its industry-leading high costs, enough that they want to wholly own it to mine themselves. So it seems like there's still plenty of strategic optionality left in that asset at least. Otherwise, why bother? Oh, and it's not the first swing the company has taken at Sierra. They tried offering Sierra a recapitalization plan back in January 2023, which was never made public. So they've been after these assets for a while. Why? Well, it's certainly not because they don't like what they see. Alpayana says they have a track record of operating and generating value from old underground mines with low-grade complex operations. Clearly, there's enough value within Sierra to still merit the effort of acquiring it. All right, so let's wrap things up here. Alpayana, for what it's worth, has stated that the current offer will expire on April 25th, 2025. The prior offer was said to be in place until April 14th, but obviously it didn't generate enough interest to meet Alpayana's thresholds, leading to this larger offer. Given market conditions currently, this renewed offer wouldn't surprise me if it was successful. It seems like a decent deal for shareholders, and for all those out there claiming it still undervalues the company, well, it's more than a 40% premium to where the name was trading earlier this week. So that tells you what the market perceives the worth as being here. All right, everybody, thanks for watching. If you enjoyed the video, you know what to do. Smash that like button, subscribe, ring that notification bell. Also, guys, if there's stories you want us to cover, let us know in the comment section. Thanks for watching, everyone.